Over $6 trillion vanished in just 1 hour. If you bought right at the top, thoughts and prayers. Silver just plunged from 121 down to 108. Gold dumped from 5,600 to 5,100. And the truth is, most people have absolutely no idea why any of this happened. Somewhere right now, someone is staring at their screen, watching their portfolio bleed in real time. Liquidations triggering more liquidations. A chain reaction of red. Stop losses getting hunted. Leverage positions getting completely wiped out, and the mainstream financial media, they'll tell you this is just volatility. Normal market behavior. Nothing to worry about. That's a lie. What happened today was not random. It was not mysterious. And if you don't understand exactly why this crash happened, the next one will destroy you. Here's the thing though. I've seen this exact setup before, not years ago, not even months ago, weeks ago, December 2025, the final 2 days of the year. Same type of crash. Same panic, same liquidation cascade. And do you know what came next? January exploded. Gold surged 30%. Silver rocketed 65%. One of the biggest monthly rallies in decades. So the real question is this: was today the end, or was it the opening move of something much bigger? By the end of this video, you'll know precisely what caused this crash. You'll understand the hidden force that actually drives gold and silver, the one most investors completely ignore. And I'll walk you through a historical pattern that may tell us exactly what comes next. But here's what most people won't hear anywhere else. I'm going to make a very specific prediction with a specific date on the record. If you click away before that, you'll miss the one detail that could turn this crash into your biggest opportunity. Stay with me. This matters. Welcome to the hidden economy. If you're new here, I cut through the noise and show you what's really happening in markets while everyone else is distracted. Subscribe now, because what you're about to see could protect your portfolio. Let's break down exactly what happened. Today is January 29th, 2026. Around 10:30 a.m. Eastern Time, gold was trading at $5,600 per ounce. Silver was sitting at $121. 60 minutes later, gold had collapsed to $5,100. Silver fell to $108. That's $500 erased from gold and $13 wiped off silver in one single hour. Put that into perspective. If you had $100,000 invested in silver at the top, you now have $89,000. $11,000 gone in the time it takes to watch a Netflix episode. If you were leveraged, if you were trading on margin, if you bought short-dated call options, liquidations triggering liquidations wasn't just a phrase, it was reality. When prices drop fast, leveraged traders get margin calls. They're forced to sell. That selling pushes prices even lower, which triggers more margin calls, more forced selling, more liquidations. It becomes a waterfall, a straight cascade of red. And the people who bought gold at 5,600 and silver at 121 thinking it was going higher, thoughts and prayers. Now here's what no one is telling you. This crash did not come out of nowhere. There were clear warning signs, signals flashing that something was about to break. And I'm going to be brutally honest with you. This was not an accident. These kinds of crashes never are. Somewhere, someone knew this was coming. The big players, the institutions, the ones with access to information you and I will never see. They saw the Fed signals early. They saw the China data before it went public. They positioned themselves ahead of time, and when the crash hit, they were ready. They were on the right side of the trade, buying your panic sells. That's how this game works. It always has. The only real question is whether you keep playing the victim or you start learning the rules. Before I show you the true cause, you need to understand something critical. Gold and silver didn't crash because there's something wrong with gold or silver. They crashed because of something else entirely, and that something has a name, the DXY. If you don't know what the DXY is, pay very close attention because this may be the most important concept you learn today. And I can promise you, 90% of retail investors have never even heard of it. DXY stands for the US dollar index. It measures the strength of the US dollar against a basket of major currencies: the euro, the yen, the British pound, the Swiss franc, the Canadian dollar, and the Swedish krona. When the DXY goes up, it means the dollar is strengthening relative to those currencies. When it goes down, the dollar is weakening. Here's the part that will permanently change how you see gold and silver. Gold and silver move opposite the dollar. They are inversely correlated. Not sometimes, not occasionally, almost always. And this is crucial. Gold and silver are priced in dollars. When the dollar strengthens, it takes fewer dollars to buy the same ounce of gold, so the price falls. When the dollar weakens, it takes more dollars to buy that same ounce, so the price rises. Think of it like a playground seesaw. The dollar sits on one side, gold and silver sit on the other. When the dollar side goes up, the metals side goes down. When the dollar side drops, metals rise. They cannot rise together. They cannot fall together. The seesaw simply doesn't work that way. This is why professional traders don't just watch gold and silver charts. They watch the dollar. They watch the DXY, because the DXY often tells you what gold and silver are about to do before they do it. Today, the DXY surged. The dollar side of the seesaw shot up, and gold and silver were crushed. This isn't complicated. It's not a conspiracy. It's not manipulation. It's basic market mechanics that most retail investors completely ignore. They stare at gold charts. They stare at silver charts. They refresh their screens all day, but they never look at the dollar. Then they're shocked when this happens. They scream manipulation. They say the market is rigged. The truth is they were watching the wrong thing. If you learn nothing else from this video, learn this. Watch the DXY. When the dollar spikes, expect pain in metals. When the dollar falls, expect gains. And here's the scary part. Most retail investors have no idea this relationship even exists. They buy metals without ever checking the dollar, then wonder why they keep getting stopped out, why they always buy at the wrong time. The market isn't rigged against them. They're just blind to the bigger picture. Institutions and hedge funds watch the DXY like hawks. When they see the dollar spike, they dump metals before retail even realizes what's happening. By the time you see the red candle, they're already out. You become the exit liquidity. And today, unless you understood this, you were exit liquidity for someone else. So why did the dollar surge today? Understanding the why helps you anticipate what comes next. There are 3 reasons, and all 3 matter. Reason number 1, the Federal Reserve. The Fed has been sending extremely hawkish signals. Hawkish means they're leaning toward keeping rates high or even raising them. Dovish means cutting rates. Right now, the Fed is very hawkish. Higher interest rates make the dollar more attractive to foreign investors because higher rates mean better yields on U.S. treasuries and dollar-denominated assets. So foreign investors convert their euros, yen, and pounds into dollars. More demand means a stronger dollar, DXY rises, metals fall. The Fed didn't cut rates nearly as much as markets expected this year. Inflation fears are back, they're talking tough, and the market always listens to the Fed. Reason number 2, China. And this one hits silver especially hard. China's industrial activity is slowing. Manufacturing data is weakening. Factory output is declining. Economic momentum is fading. Silver isn't just a precious metal, it's an industrial one. Over half of silver demand comes from industrial use: solar panels, electronics, EVs, semiconductors, data centers. And most of that manufacturing happens in China. When China slows, industrial demand fears explode. Traders start pricing in lower silver demand. Selling begins. And because silver is more volatile than gold, it drops harder. That's why silver fell 11% while gold fell 9%. Reason number 3, the looming U.S. government shutdown on January 31st. Markets hate uncertainty. Political chaos makes traders reduce risk. After massive gains this month, gold up 30%, silver up 65%. Many investors were sitting on huge profits, just waiting for an excuse to sell. Shutdown fears gave them that excuse. 3 forces hit at the same time: a hawkish Fed, slowing China, and political uncertainty. Individually, they might have caused a dip. Together, they erased over $6 trillion in 1 hour. Now let's talk about something most people misunderstand: the relationship between gold and silver. They move in the same direction, but not with the same intensity. Silver is gold on steroids. When gold moves 5%, silver moves 10 to 12%. Gold drops 8%, silver drops 15 to 20. That's the silver multiplier effect. Gold leads, silver amplifies. That's why silver gained 65% this month versus gold's 30%, and why silver crashed harder today. Look at Monday. Silver fell 14%, but gold only dropped 2%. That crash was silver specific, driven by China fears. Today was different. Both metals fell together. That tells you this was macro-driven, the dollar. Now here's the part you really need to hear. I've seen this exact pattern before, December 30th and 31st, 2025. Same crash, same panic, same despair. Social media was full of doom. People called the bull market over. Then January happened. Gold up 30%, silver up 65%, one of the strongest months in decades. Today is January 29th, 2 days before month end. Same setup, same fear. Will February repeat the pattern? Here's why it might. Nothing fundamental changed. Tether is still buying tons of gold weekly. BRICS nations are still accumulating. De-dollarization is accelerating. Silver supply deficits remain. Mines are still depleting. Only sentiment changed, and sentiment flips fast. In bull markets, sharp crashes shake out weak hands, reset conditions, and give smart money a chance to accumulate. Nothing suggests this bull market is over. This looks like a correction, not a reversal. Now my on-the-record prediction. Silver will be back above $120 by February 15th. Screenshot it. Hold me accountable. If you're holding physical metals, do nothing. Physical gold and silver aren't trades, they're insurance. If you're leveraged, today was your warning. Reduce it or eliminate it. And if you're holding cash, this may be your moment. But buy slowly and wisely. Markets transfer wealth from the impatient to the patient. Today, $6 trillion changed hands. Next time, make sure you're on the right side of that transfer.